Thank you, Jerry. It's kind of nice that after 10 years we finally were able to get through all of the overviews and introductions and all that on time. We're actually starting 1 minute ahead of schedule right now, so we're in good shape. Our first speaker this morning is Stephen Nicholson. He is a grains and oilseeds analyst with Rabobank Food and Agribusiness Research and Advisory Group. Rabobank is a global financial services leader providing institutional and retail banking and agricultural finance solutions in key markets around the world. Stephen has more than 30 years of experience in cash grain markets, hedging, commodity and ingredient procurement, commodity risk management, and commodity analysis. A native of Iowa, he holds a Bachelor of Science in Farm Operations and Agricultural Education, as well as a Master of Science in Agricultural Economics from Iowa State University. Prior to joining Rabo AgriFinance, Stephen was most currently Category Manager and Chief Economist with International Food Products, a trader and distributor of food ingredients. He was responsible for procurement and trading of vegetable oils, corn sweeteners, starches, and grain products, along with consulting assignments. Stephen also worked as an oilseed analyst, senior buyer, and senior commodity analyst. Please welcome Stephen.
Good morning, everybody.
Thank you for having me. It's an honor to be here. Am I on? Can you hear me? No. Nope, now it's on. Can you hear me now? Okay, good. So, first of all, thank you for having me this morning. And as Jerry said, and thank you, Dale, we're going to drink from a fire hose. Jerry, when I got started and he talked about your meeting, he said, well, I'd like to go through this and this and this and this. And then he had 3 or 4 more other things, and he said, then you need to do that in about 20 minutes. I'm thinking, boy, that is going to be fast. So we're going to get going and roll the videotape. As you'll hear probably from Elizabeth and from other speakers today, the world has really changed in just the last couple of years for us. And for those of us in agriculture, it's in some ways not a happy time. But let's talk about what's going on so we understand it.
Yeah.
Is that better? How's that? Everybody says okay? Okay. So we're going to talk a little bit about the macro outlook very quickly, talk a little bit about currency, because currency certainly is important, and we'll talk wheat, corn, soybeans, and go from there. This doesn't sound very good, does it? See if that'll help. One of the things that's changed a lot of us, and they've certainly been in the news, of course, has been China. And you can see the red line on that chart is China, the black line is India, and the yellow line is Southeast Asia. When I look at Southeast Asia, I'm talking about Vietnam, Cambodia, Philippines, Indonesia, Malaysia, all those sorts of things. And you can see that China's come down. They've certainly been in the news a lot. And Elizabeth can talk a little bit more about, you want to go this way? That's fine, I'll just use the podium, how about that?
Okay.
We'll turn this off and we'll start over. Okay. So anyway, when we look at what's happening, of course, China is an important piece and will continue to be an important piece. And I want to caution people that the sky is not falling. China still has 1.4 billion people. Yesterday they had 4 billion people today, and they're going to have 1 more billion people tomorrow. So they're still going to eat. The mix might change, but the fact is they're still going to be here. We see India as a very important part, and I'll talk a little bit about that later. But they've got 1.2 billion people. They're a very young population. They're highly educated. I'm not, saying the fact that there's a lot of abject poverty in India, but the fact is they're a growing democracy that will be an important part of what's happening globally. Southeast Asia is where we think there's a lot of growth potential. When you see what's happening in China, all that manufacturing is going offshore of China into Southeast Asia. And the fact that they have a lot of people growing and the fact that they continue to be a very good customer of United States products, we think that's where the growth is going to be in an area of the world that we're watching very, very closely. Jerry asked me, he said, what about interest rates? Well, of course, everyone wants to know about interest rates, and farmers, of course, are always very interested in interest rates because it costs money. And this comes out of the Federal Reserve Open Market Committee. This comes out of the notes of the December meeting. And what this is a survey of all the governors of where they think interest rates will be in the forward quarters or the subsequent quarters from where we are now. And you can see that they're expecting interest rates to go up. Now, it's not a big move. It's not going to be horrible. When we look at some of our internal work that's done, some of my colleagues out of New York and London, We think the FMOC will probably be in that, as we get to the end of 2016, someplace in that 1.1% area type. Not a big thing one way or the other, but again, obviously there's going to be an increase, but I will tell you, if you look at an old chart that looks at interest rate increases over the years, and everyone's predicting rate increases and they just keep going down. So we really can't go any farther down, but the fact is we're probably in for seeing some increases. Probably one of the biggest things that's really hurt commodity prices has been oil. Oil prices yesterday I think hit 32 bucks a barrel. When I pulled up to my gas tank in St. Louis here this weekend and I paid $1.51 for a gallon of gas, if you'd told me even a year ago that I would do $1.50 gasoline, I wouldn't believe it. But the fact is that we just have a glut of oil in the world. The demand, China, because of their demand situation, because their economy is, is contracting. And I just say contract because it's still growing, it's just not growing as fast as it was. And the fact is that because they're not demanding oil, iron ore, aluminum, zinc, copper, all those what I call hard commodities, that's put a lot of pressure on all commodity markets. I don't think that's going to change anytime soon. So that's probably, if there is a good side to this, is that the Chinese demand is slow, and that will keep our input costs down, but at the same time is going to keep downward pressure on commodity prices overall. One of the things, and Elizabeth's going to talk about this, and I don't want to go too deep into this, but if you look at this chart, the feed grain and the food grain demand that's not where the growth has been. It's still going to be there over the next 10 years, but the really demand is going to come when you look at the oilseed side and you look at soybean meal and particularly oil seeds and also oil. Now this just looked at soybean oil, doesn't include palm oil. And if you included palm oil, it'd be a lot different situation. It'd also be very high. But the fact is the demand for animal protein continues to grow in the world, so we're going to need a lot more soybean meal to feed those animals, particularly when you look at chickens and hogs, obviously, and other poultry, turkeys. But you're going to need a lot more oil to cook those. And so we think those are the areas, and we continue to see growth globally in the oilseed markets going forward. One of the things that we get asked about, and this is global stocks to use ratio, and I want you to focus on the yellow line, which is corn. And corn tends to always lead. Put it up. Is that better? Okay. If you look at, it just seems really loud up here, but that's okay. When you look at the yellow line, which is the global stocks to use for corn, you will note that back in that early 2000 timeframe, you saw that global stocks to use ratio for corn just go almost to zero. And that's what was one of the reasons that led the big commodity boom. And you can see that that soybeans and wheat also followed that pattern, but corn was really the leader in that. And now in the last 3 years, you've started to see that global stocks to use ratio go up for corn. And with that, it tells you very quickly that the demand now has finally caught up with, or the supply has finally caught up with demand. We could not produce enough corn, soybeans, wheat to fulfill the demand, and now we're doing that. And I think as an economist looking at it, I think I was surprised how long it took us to get there, but the fact is we are there now, and we are all supplying enough for the world's demand. And that's where the world has changed dramatically. One of the things I just want to point out, and we looked at this, and this is looking at percentage change from 1960, so keep in mind it's a long time ago, but the green line's corn, the orange line is beans, and the yellow line is wheat. But you can see that corn's increase in yield has been over 200% since that time frame, and corn and wheat, or beans and wheat, has really lagged behind that. And people always ask, why do we keep planting corn? And there's one of the reasons right there is the fact is that the farmer sees and has that expectation that the yield potential is there, and that's not going to change anytime soon. Now there's been a lot more investment in wheat genetics and soybean genetics going forward, and that we'll probably start to see soybean and wheat yields move up, but the fact is corn has a very, very big lead on them right now. But I just wanted to point that out, and why people say, why do we keep planting corn at low? There's the reason right there, but let's kind of start to look a little bit closer to home. This is looking at acres for corn, soybeans, and wheat. We've got about 90 million acres of corn. That's a little bit of an increase for this year. We're expecting about a 500,000 decrease in soybean acres. Not a big move one way or the other. Right now, if you look at that rule of thumb corn to soybean ratio, you're seeing corn have a little bit of advantage. And also, when we look at wheat, we don't have a lot of expectations that wheat demand will continue to, or wheat acreage will grow all that much. And I'll talk a little bit more about that here in a second. Let's talk about currency. Currency is always the issue that people worry about, think about, and where is it going to go. But let's talk a little bit about where the U.S. dollar is right now. I would argue to you that the U.S. dollar now trading in that 92 to, this is the index, no, I should reference this is the U.S. dollar index. When you look at that dollar index, we're trading between 92 and 100. If you look at the long-term average back to the 1980s, it's about 98. So I would argue that what we've been through, where we had high commodity prices and the low value of the dollar helped contribute to some of that, was a bit of an abnormality. And now we're back sort of at a normal time. But our problem is that our USA current competitors are extremely, their currencies have been really beat up or depreciated. The red line there is the ruble. The blue line, of course, is Argentina, and we'll come back to that in a minute. The green line is the real. But when you look at our major agricultural competitors, like the Black Sea area, Russia, Ukraine, Kazakhstan, you look at Argentina. Argentina is starting to get their act together, and that's sort of a relatively terms. And then you look at the green line, which is Brazil, you see increased demand or increased consumption or increased production, and get all those right words in there, increased production in those areas of the world that are going to put a lot of pressure on world commodity prices, which is going to make our commodity prices look a little bit too high. And with that, that's going to continue to drive prices lower so that we are competitive in the world. We think that we probably have some more time for this to continue to play out. The dollar looks like it's going to be strong, and I always kind of make the joke, and the reference to Donald Trump and the caucuses coming up. You know, we have the worst economy and the worst political system in the world except for all the rest. And so because of that, the dollar continues to be a very strong dollar, a strong currency in the world, and probably will continue to be so. Some of the impacts of that, of course, are wheat. The red pie there on your left is the U.S., and you can see we had about 40 to 45% of the world's demand or export trade, and now we're down to about 20% of the world demand. It's changed dramatically. Now the pie's gotten bigger, that's the good news, but the fact is we've lost market share. And if you look at that also in the context of corn and soybeans, it's a very similar picture. We've lost market share in the world, both of corn and of soybeans. When we look at the currency impact, wheat is probably going to be the biggest loser. We have exported traditionally 30 to 40% of our wheat in the world to the world, and of that we produce. So keep in mind our S&D or our balance sheet, and the U.S. is probably going to be the biggest loser in that. Or the wheat is going to be the biggest loser in that. Corn to a lesser extent, and beans to a lesser extent. Although the caveat with soybeans is, does China continue to take and continue to increase their demand every year? So we'll talk about that a little bit later as well. But I want to show you soybeans in general. And you remember me talking about how with the increase of production in Brazil, and here's one of the reasons. The blue line is dollars per bushel. The green line is reals per bushel. And if you look back at the 2014 lows, and you take that today on dollars per bushel, the U.S. farmers lost 2 to 3% value on dollars, and that's in the futures market. You look at the green line, the Brazilian farmer has seen about a 60% increase in the value of his beans. So what do you think he's going to do? He's going to plant, or she is going to plant more soybeans. And they are planting beans everywhere this year. So they are going to continue to push, and increase supply. And they're going to be the low-cost producer in the world, and that's going to put a lot of pressure on commodity prices and put pressure on our prices here to be competitive in the world. So let's turn to wheat. As I said up front, wheat is going to be probably the biggest loser in this currency war. And I was talking to a colleague here just on Friday, and we were talking about wheat, and she said to me, what do we do about wheat? And I have to say, it is a real conundrum about wheat. What does the wheat grower do going forward? But it is a real big issue. We are not competitive in the world, and it's not really our fault, but the fact is that there are other competitors in the world that are extremely competitive, and I'm thinking of the Black Sea in particular. This is our forecast for wheat prices going forward, and you can see both Chicago and Matif on there if you're interested in Europe. But when we really look at Chicago prices, we're kind of hugging that $5 area. Now that means there's a lot of volatility, there's some volatility around that, but not a lot. And I'll talk a little bit about corn and soybeans as well. But one of the things I want you to take away from these charts, and you'll see all three of these for all three crops, is the fact there's not a lot of volatility going forward. And that's a bad thing for all of us. I've been on the buyer side, I've also been on the seller side. And you want volatility because it provides you opportunities to buy and it provides you opportunities to sell. And we don't see a lot of that going forward, barring droughts and floods and all those sorts of things. But the fact is, when we look at 16 and even beyond, prices look pretty flat to a little bit down. There is an exercise I do, and you'll see this on corn and soybeans as well, is I look at just the bullish and bearish factors in the market, and I kind of brainstorm for myself because it kind of gives me an idea as to, am I missing something? How do I position the market? And I kind of come out, and I hate to say it, but I kind of look at, do I have more bullish factors than bearish factors, or more bearish than bullish? And you can see the wheat situation, there's a lot more bullish factors going forward. And that's going to be a real challenge for the U.S. wheat grower. There you see monthly Chicago wheats kind of find support in that 450 area. And if you look both at Kansas City and Minneapolis, they're finding pretty good support in their respective areas. But I will argue too that the demand for wheat in the world and the demand for corn and soybeans in the world is greater. And the fact is probably there's not a lot more downside risk here. But the fact is we'll see what comes going forward as far as what the production and what Argentina does with the crop they have in storage. But the two big factors, and this is the first one, is just the fact we have more wheat in the world than we know what to do with. And the fact that we have such large stocks in the world is going to keep pressure on prices both globally and here in the United States. You can see the stocks to use ratio, while it is not as great as it was back there early in the chart, but you can see that it is moving upward. Again, showing us the fact is that the global demand or global supply is catching up with that global demand. So we have more than enough. So there's the first factor. The second is exports. You can see we've got the Black Sea, Canada, the European Union, and the U.S. in this chart. And I know there's a lot of lines there. The red line is the U.S. And you can see how the European Union, you can even see Canada coming up, and you can see, of course, the Black Sea is just almost off the chart. They're increasing share, and they're also increasing push into the global market is really put a lot of pressure on our exports. And we don't see that changing anytime soon, unless there is some sort of a weather issue, obviously in the Black Sea or Europe. 2 years ago, I think I'm correct about that, we saw the U.S. had some advantage because we had milling quality wheat in the world and Europe had a bad crop. So those things happen, and those are opportunities that will come down the line. But the fact is, number two is, U.S. wheat exports are down, and the fact is that there's a lot of wheat in the world, and we're sort of getting beat to the marketplace. The other third factor is U.S. wheat stocks. We have a lot of U.S. wheat stocks. Now, the stocks to use ratio, or the price, of course, you can see is coming down as stocks go up. And so as an economist, that makes me happy that relationship is still there. For a while, we wondered about that when we saw declining stock, we saw increasing stocks in some cases back in the boom, and we still saw prices going up, and we're like scratching our head. And now it's like Chairman Greenspan had said, some people thought that the rules of economics have been repealed. Well, they haven't, so we're all happy about that. But the fact is, we have a lot of wheat stocks here in the United States, and we don't have a home for right now. The demand domestically is growing, but Elizabeth's going to talk about this, but the fact is it's growing very slowly because of a population. So there's number three. We have a lot of wheat stocks in the United States. So that's kind of the ground on wheat. I hate to paint a gloomy picture, but the fact is it is what it is, and I think we need to talk about that and have that discussion. Corn. The next biggest, really the biggest crop in the United States, the one that drives everyone else. It does drive wheat. If corn prices are low, wheat tends to be low. If corn goes up, wheat tends to follow. Again, there's the bullish factors on beans, or on corn. You can see, again, very much like wheat, there's a lot more bearish factors than there is bullish factors. And I think the thing with corn, and I don't show the demand or the balance sheet here, but when you look at the balance sheet for corn, and supply is what it is, and we will get some new numbers here this morning, and should remind everyone of that. And I guess maybe we should say, as an economist, that everything we say is going to be outdated in the next hour or so. But the fact is, when you look at the balance sheet for corn, there's not a lot of opportunity for growth on the demand side. We're going to feed 5.2, 5.3 billion bushels for feeding. We're going to use about 5.2 billion bushels for ethanol, 1.2, 1.3 for FSI, and that's about it. And we did that last year, and we're going to do that about this year, and we're kind of looking for that next year. And so the corn lobby, if you have it, or the corn sector needs to find a new growth sector. What that's going to be is going to be interesting to see where it goes. Of course, people have varying opinions about that, but corn probably doesn't have a lot of upside or downside at this point. And there you can see, there's our corn forecast. It's kind of hugging that $4 area, kind of 375 to 425 range when you look at it going forward. But again, not a lot of volatility. So again, not a lot of opportunity from the sell side, and not a lot of opportunity on the buy side going forward. There's your weekly corn futures chart. We've kind of settled back into that range that we saw in 9-10 after we came off the huge, boom, right, and then the resulting recession, excuse me. And we kind of settled into that area. Again, kind of that 375, 4.25. Maybe you stretch it to 350 to 450 before it's all said and done. But again, a pretty narrow range from where we have been going forward. I throw this in here so you'll think about what stocks do. We always show the chart like we looked at wheat stocks are high, price comes down. But the reality is that it reacts not only to that, but it also reacts to that change. And the market anticipates that. And you can see now that we have corn stocks have gone up as you look at the right hand of that chart. And you see they're pretty flat going forward. We don't see a lot of growth in stocks, this year or even the following year or even, 2 years down the road. And then prices will be pretty flat. So prices do react to those changes in stocks. And so keep that in mind as you do your planning and thinking about going down the road. The other really kind of stunning thing when you think about prices, and this is back to 1900. In the last 2 times when we've moved up to a new price plateau, prices go high and then they take a very slow move down. And you can see the blue line there is the trend line, the green is the average farm price in that crop year. And you can see that with the last 2, we've kind of got that high and then we make a slow gradual move down. We've moved up to this higher plateau. We think that plateau is there to stay. We're not going back to $2 corn, as some people have wanted to argue this year. But the fact is, we'll probably see that plateau. We'll see those prices slowly slide. And there's really the reason why. When you look at the prices, and I'm going to run this animation so it's a little quicker, but you can see the bottom curve is the demand curve before we got to 2006, 2007. And then as we got to 2007, 2008, that demand curve moved up and to the right. So that's why we're arguing that we're not going to see prices back to $2 or $2.50 like some people tried to argue. But the fact is we've got prices have moved into a new plateau. So that's the good news. Now the bad news about all this is that we've now moved to the very right tail of that curve, back into that $3.50, $4 area, because that's where the stocks to use ratio is leading us at this point. Elizabeth's going to talk about yields, but I just want to make one point about yields. And this, if you look at this chart, this is corn, but if you look at wheat and you look at soybeans, you get a very, very similar picture. The green lines are the actual and the trend. The blue is the change year over year. And you can kind of see very pointedly that there are times when we have very low volatility in yields and we have very high volatility in yields. We've come out of a time here recently of very low volatility, and we believe we're entering a time of a little higher volatility in yields. So that has some ramifications for price, has some ramifications for price risk, and ramifications for marketing. So as we enter this time of a little more volatility, it's about a 15 to 18-year cycle. For those of you who are weather people, you will note that we believe that there are weather cycles, and yield is a direct function of weather. So something to think in mind going forward. One of those things you can't predict, but one of those opportunities. We've had a lot of questions about corn exports in China. Well, what about China? When are they going to import more corn from the United States? And the red bar, or the red tips of those bars, is China. And you can see that China has been an on and off customer of U.S. corn. They're not a big demander of corn from the world because they want to be self-sufficient in feed grains. We all know that that's not going to be possible, but the fact is right now they have more corn and they know what to do with. Their banning of DDGs into China had nothing to do with of that GMO trade of MR 162. It had all to do with the fact that they had more corn than they wanted to do with. The fact that they've increased the income or the imports of sorghum and barley, that's because corn was too high priced, and the feed compounders wanted another opportunity. Well, the Chinese government is slowly shutting that down as well. So they have more feed grain they know what to do with, and that's not going to change anytime soon. We think that there's probably at least a year, maybe 2 years before that they'll be back into the global market for feed grains. They have that much corn in stock. Now the questions, of course, is what is that actual number and what kind of condition that corn is in storage. So something to be watching and paying attention to, and those of us in the corn market watch very, very carefully. One of the other players in the world is Brazil. Brazil has continued to increase their corn production, and the dark line there is their production, and the bottom is their demand side. You can see their demand has continued to grow. Brazil, when you look at their corn production, they have two crops. They have a first crop and then a second crop of safrinha that is planted after their soybean crop comes out of the ground about March. And that crop is planted merely as a companion. It's really almost a companion crop, and it was this afterthought because it does a very good thing for them. It breaks up the soil. It breaks that pattern of disease, insects, and fungus in the crop. And what's happened is the second crop, or the safrinha crop, has now become their biggest crop. And the Brazilians, not unlike us, now have a lot of corn they don't know what to do with. And so they're trying to find places to put it, and the expectation is that they're gonna feed it to animals. And so we're seeing an increase in their cow herds, or their beef cow herds, and we're beef herds, also in their poultry. Pork they're not as big in, but they're trying to we think that that'll come later. But the fact is, they're exporting about 20 to 25 million metric tons a year, and that's been a big increase from where they have just in recent years. So another global player or competitor we have to be concerned about on corn now. There's corn ending stocks. The green bars you can see pretty flat, and consequently prices are pretty flat as well. It's not growing, it's not decreasing, but still pretty hefty stocks going forward. So that's the corn story. We'll wrap up with soybeans. Not as important a crop in most areas where potatoes is grown, but it is an important crop because of what it can do and where the opportunities are for the U.S. market. Again, the bullish and bearish factors, you can read these as well as I can. A few more bullish factors. Part of that is because there still is a growing demand for oilseeds in the world, whether it is here, whether it is in South America, or whether it's in China. And the big wild card down at the bottom is China. Will China continue to increase imports of oilseeds or soybeans, but primarily, at 2 or 3 million metric tons a year? Right now, it seems like they're willing to do that. I will tell you that I think the market is a little concerned about what's happening in China, and the fact is that the economy is so bad. While GDP is an impact of that, the fact is they still have to feed 1.4 billion people every year. And they also, from a standpoint of jobs, crushing plants provide jobs for people. And so they will continue to produce oil and meal for their needs. They're probably seeing their hog population or hog numbers start to increase. They've come down dramatically over the last couple of years, but we'll probably see that increase as well, which will be good for demand for meal. Not unlike corn and wheat, soybean prices, future prices, kind of hugging that $9 right now. We're below there significantly. If you saw when you pay attention to the corn chart, the demand for corn, the demand curve for corn, the bean one looks very similar in the fact that it's moved up and to the right. And the fact is that we don't see bean prices going back into that $7, $6 area. The fact is, because the demand curve has moved and where stocks to use ratio are, now we're on the right end of that, right side of that tail, but the fact is we are going to see continued good demand for beans, which will help prices at least stabilize here at current levels. But again, not a lot of volatility, barring basic weather issues primarily, or a new demand shock we don't know of today. Like corn, we've seen soybeans have even got into a little bit of a tighter range. The upside looks pretty limited. Maybe that 950 area is where we could get. You can see a big gap there in that one arrow, and the fact is we found pretty good support here recent, and again, very similar to back to that 910 area. So again, not a lot of volatility, but not a lot of downside risk from where we are at this point. The world production of soybeans, as you can see, continues to grow. It's not quite a straight line. It's pretty doggone close, but the fact is both Brazil and the U.S. are the big dogs in the block, and in our view will continue to be, bless you, will continue to be the big dogs on the block going forward. We don't think that'll change. Of course, the wild card is China. If China all of a sudden says we've had enough and we're not going to do any more soybeans, then we're done. Brazil and Argentina, or Brazil and the United States will be the dominant. We think, again, because of China. China likes to have two suppliers to play off each other. They get the cheap beans in the fall from us, and they get the cheap beans in March from Brazil, and they like that. Like that dichotomy. Argentina is the big question, and I haven't really spoken a lot about Argentina, other than you saw the depreciation of their currency. The new president of Argentina is. I don't want to put too much on at this point other than to say it's a bit of a breath of fresh air that maybe they'll get their economy, I don't want to say straightened out, but relatively in a better path than they have been. That will be good news for a lot of people. It'll be a little tougher on us as an exporter of commodities, but the fact is their farmers have been holding on to a lot of beans. They have large bean and meal stocks, and I'll show you that in a minute. But with a cheap peso, and the fact is it's probably going to stay cheap, we'll probably start to see those beans come onto the world market, and they'll be a little stiffer competitor than they have been, because they really have not been a part of the conversation or equation over the last 2 or 3 years. But there you can see this is the world soybean imports, the dominance of China. They're about 65% of the world's soybean trade comes out of China, it goes to China. The rest goes to lots of different places in the world, but China remains a very dominant player, and as long as that happens, the soybean market and all soybean farmers will be happy. There is the demand curve for soybeans. We're out on that right side of that tail. We're getting down to that $8.59 area, and we expect that that's probably where we're going to do. The circle is this year's numbers, and you can see that we felt good when we got this, when we built this demand curve and we did the equations and put it together and we put this year's next to it, it all fit, and we thought, yay, we did the right thing. So the fact is that the demand curves does show gives you a lot of important information about the market. One of the factors and one of the important things about soybeans as I finish up here is meal. The green bars are annual, or the red bars are annual year-over-year increase in soybean meal demand. And this is on a global basis. And you can see that even with these high prices of the last 3 years, we've increased or had positive growth in meal. Incredible. And the fact is that prices become less of an issue for everybody. One of those is India. India's oil meal exports, you can see, typically don't do much from April until about October, and then they spike. But if you look over the last 2 years, they've been basically flat. They have done absolutely nothing. And we saw, and I took that one out, but if you look at the fact is someone's going to have to fill that hole in the world market. Probably be South America because of that south-to-south trade flow. But the fact is, and that opens up a hole someplace else, and the U.S. will have an opportunity to pick up opportunities for more meal exports around the world. There's Argentina, and I mentioned that briefly. They have huge stocks of meal and soybeans. We would expect that those will start to move here now that the fact that the farmer sees, 13 pesos to the dollar. He gets a lot more for his beans than he did just a month ago. And there's your soybean ending stocks. Basically pretty flat from last year, but we expect to see we're going to be in that 450 million bushel area, meaning prices will be fairly flat and just not unlike corn. So that's it. I will stop there. I will be around. I don't want to intrude on other people's time. If you have questions, we can take them now, or I'll be around and we can certainly talk later. So thank you much for your attention, and it's been a privilege to be able to kick your meeting off and have a successful meeting. Thank you.